Welcome to the Deep Dive, the show where we really try to distill complex information into actionable insights. Today, we're plunging into Microvast Holdings Inc. That's NASDAQ ticker MVST. Now, this is a company that's battled years of losses, geopolitical headwinds, you name it. So the big question, is it finally turning a corner towards, sustained profitability? Or are the fundamental risks about to pull the plug on its recent rally? We're going to try and uncover exactly what the upcoming earnings report means for this pivotal moment. And just so you know, all the data and analysis we're presenting, it's current as of August 8, 2025, with the share price sitting right around $2.83.
Yeah, and the timing is, well, it's critical, really. Microvast's second quarter 2025 results are due after market close on Monday, August 11th, so very soon. And Wall Street, they're basically predicting Q2 earnings per share right near breakeven. Maybe zero, maybe a cent. It's a huge psychological hurdle after all those years in the red. Remember that surprise GAAP net profit of 0.19 cents a share in Q1? Analysts are starting to think, okay, maybe that wasn't just a fluke. They're forecasting full year 2025 EPS around 0.9 cents. That signals real expectations for sustained profitability going forward.
Okay, so when those numbers drop on Monday, what are the absolute key things investors and analysts need to be watching, like the make or break points?
I'd say there are four main things. First, gross margin sustainability. Q1 hit this incredible 36.9%. Amazing number, but the full year guidance is closer to 30%. So is Q1 an outlier, or is this new level actually sustainable? That's question one. Second, revenue growth and guidance. How are they actually tracking towards their full year target? It's $450 to $475 million. Need to see progress there. Third, backlog evolution. There was a sharp dip in late 2023 that made some people nervous. So seeing strong new order intake is pretty vital to rebuild confidence. And maybe most critically, fourth, cash flow. They burned through a lot of cash historically. Can they show that the positive operating cash flow trend from Q1 is continuing? Can they actually self-fund operations now? That really de-risks the whole investment thesis.
Wow, okay. That's a lot riding on one single report. So to help you, our listeners, wrap your heads around this company, we've structured this deep dive into two main parts across 7 chapters. Part 1 will cover Chapter 1, business analysis, then Chapter 2, management evaluation, and Chapter 3, financial analysis. Then in Part 2, we'll shift gears and dive into Chapter 4, market sentiment, Chapter 5, ownership structure, Chapter 6, risk assessment, and finally, bring it all together in Chapter 7, conclusion.
And just a heads up for this stock, definitely stay tuned. We plan on covering its earnings pretty much within minutes of them being released.
Okay, great. Let's kick things off then with Chapter 1, business analysis. When you look at Microvast, what's really the core of their business? What makes them, stand out in this super crowded battery space?
Well, the foundational thing for Microvast is their full vertical integration. They aren't just buying components and slapping batteries together. No, they control the whole chain, designing the basic chemistry, cathode, anode, electrolyte, and that crucial separator, all the way to building the final battery systems. That end-to-end control, it gives them a real handle on quality, performance, and costs too.
Right, and you see that in where their money comes from. They're selling these advanced battery systems mainly to commercial EVs, think buses, heavy trucks, but also these big energy storage systems for grid stabilization, smart tapping into 2 huge electrification trends at once.
Totally. And their own tech is a big differentiator. Sure, they use common chemistries like LFP and NMC, but it's their proprietary stuff that sets them apart. Like they've got this polyimide separator. It resists heat much better than typical ones, which drastically cuts the risk of thermal runaway, battery fires. Yeah. Plus unique cathode designs, non-flammable electrolytes.
Yeah.
It all adds up to stronger safety credentials.
So definitely not some flash-in-the-pan startup. They've been around the block. What's their actual scale, their global presence?
Oh yeah, they're not new kids on the block at all. Founded way back in 2006, so that's over 18 years of operational history. And they have a real global footprint, over 31,000 battery systems deployed out there, manufacturing in Huzhou, China, Ludwigsfeld, Germany, and that new plant ramping up in Clarksville, Tennessee. Plus, over 2,000 employees worldwide. It's substantial.
And when you put that scale together with their tech, what's the main selling point for those commercial vehicle customers? What's the value prop?
For a fleet operator, it boils down to 3 critical things. 1, safety, obvious but crucial. Mitigating fire risk is non-negotiable. 2, performance, especially fast charging. You need those vehicles on the road, not plugged in. Maximum uptime. And 3, longevity. Long cycle life means fewer expensive battery replacements over the vehicle's lifespan. Put it all together and it means a lower total cost of ownership. That's the bottom line for businesses.
Looking bigger picture, Microvast is definitely riding a huge wave, right? This whole shift in electric. I mean, the global EV battery market alone, projections are like $92 billion this year, growing to over $739 billion by 2034. That's almost 26% compounded growth annually. They're kind of like a small boat in a rapidly rising tide.
Absolutely. But that tide also carries some giants. You've got global players like CATL, DYD dominating the space. And Microvast also faces specialized Western competitors, Enovix, Solid Power, EOS Energy Enterprises, names like that. But here's what's striking. Even though they're smaller, Microvast isn't just surviving. They're actually showing a path to profit that a lot of these, frankly, more speculative competitors haven't even come close to. While some others trade at, 40, even 90 times sales, burning cash like crazy, Microvast is trading at a much more grounded 2.1 times sales. And critically, they've actually started showing positive margins. That's pretty rare in this particular space right now.
Regulations, too. That's a double-edged sword, isn't it? Opportunities and challenges. Like in the U.S., the Inflation Reduction Act, the IRA, has big tax credits for domestic battery making. That could really help their Tennessee plant if they meet the sourcing rules. And in Europe, the new EU battery regulations set strict targets for recycling recycled content. That means costs. But maybe it also creates a compliance moat against rivals who aren't as advanced.
Yeah, and the barriers to just getting into this game are huge. You need massive capital, hundreds of millions, often billions for gigawatt-hour scale plants. Plus, deep tech expertise, IP, solid supply chains for critical stuff like lithium, cobalt, and nickel. Microvast, having been around 18 plus years, has already cleared a lot of those initial massive hurdles.
Which leads right into their competitive advantages. What are they specifically?
Well, they've built a strong brand strength in that commercial vehicle niche. Those 31,000 plus deployed systems, that's a track record, proof of reliability. Cost advantages too, partly from that Huzhou, China plant. It taps into the world's most mature, cost-effective battery supply chain. That's a big driver of those recent margin improvements. We'll touch on the risk there later, though.
Right, the geopolitical side.
Exactly. Then there are switching costs. For vehicle makers, integrating a battery system deeply into a platform. Swapping suppliers means costly, time-consuming re-engineering. That helps keep customers locked in. And finally, their unique assets. That portfolio of over 810 patents and applications. Protecting the core tech, the aramid separator, non-flammable electrolyte, gradient cathode design. That's a formidable IP moat.
Okay, that gives us a really good picture of the business itself. Let's move on to Chapter 2, Management Evaluation. How does the leadership look at Microvast?
It's very much a founder-led story. Yang Wu has been chairman and CEO since day one back in 2006. That's almost 2 decades of consistent vision. And he's had success before. Founded another company, Olmex Environmental Engineering, sold it to Dow Chemical. Reports say it was a 55-fold return. Pretty impressive. And his biggest recent achievement, undeniably steering this operational turnaround, hitting record revenue and that first GAAP net profit in Q1 2025.
Okay, strong track record in some ways. But, it hasn't all been smooth sailing. Years of unprofitability burning through cash, and more recently, that disclosure of material weaknesses in their internal financial controls. Plus some instability in the finance department. A new CFO came in April 2025 and was gone just a few months later. How do you square that with the turnaround narrative?
Yeah, it definitely raises flags. It's a bit of a mixed bag. Official communications or standard earnings calls, guidance, emphasizing ethics. But, you hear things anecdotally. Market sentiment sometimes suggests CEO Yang Wu is very hands-on, maybe a control freak, some might say, and perhaps not great at PR. That can cause friction with investors wanting more open communication. Those internal control weaknesses, though, that's something concrete investors will want to see fixed and fast. It points to growing pains, maybe, but it needs addressing.
So when they do have capital, how are they allocating it? Buybacks, dividends, investing back into the business.
Oh, it's crystal clear. Every available dollar goes back into organic growth. You see it in the heavy CapEx history, expanding in China, building out Tennessee, no sign of M&A. But interestingly, they have explicitly said they're shifting focus now, from a pure build phase to more of an optimize phase, emphasizing profitability and operational efficiency. And you see Vinyl-reflected CapEx actually decreased year over year last quarter. But yeah, no dividends, no buybacks. Typical for a growth company in this industry, priority is scale and sustainable profit.
Right. And speaking of profit, return on invested capital, ROIC, it's been deeply negative for ages because of all that investment. But Q1's profit changes the game, right? This is the first chance for ROIC to actually turn positive. What does that signify?
It signifies basically that the rubber is hitting the road. Generating strong, sustained, positive ROIC is the ultimate test. Can they prove their strategy works? It's not just about one profitable quarter. It's about showing they can efficiently use shareholder money to generate consistent returns long term. And what really strengthens this is the alignment of interests. CEO Yang Wu personally owns about 26.44% of the company. That's a stake worth over $258 million. His financial success is directly tied to every other shareholder. That's serious skin in the game, encouraging a long-term view.
Okay. Management picture is clearer. Let's get into the nitty-gritty with Chapter 3, financial analysis. What are the key numbers telling us?
Well, first off, market cap. As of our analysis date, it's around $883 million.
Yeah.
That puts them squarely in small cap territory. Higher growth potential, sure, but also usually means higher risk and volatility.
And their revenue growth, that's been a big part of the story, right?
Right.
Pretty explosive.
Definitely a cornerstone of the bull case. Look at the numbers. $152 million in 2021, $204.5 million in 22, $306.6 million in 23, $379.8 million in 24, and Q1 this year. $116.5 million, up 43.2% over Q1 last year. That consistent high growth points to really strong demand.
But the really exciting part, the thing that's got everyone talking, is the profit margins. That's where the dramatic recent improvement has been.
It really has. Gross margin jumped significantly from 18.7% in fiscal 23 to 31.5% in fiscal 24. Then boom, a record 36.9% in Q1 25. That kind of rapid expansion points to economies of scale kicking in, better manufacturing, maybe some pricing power too, and operating in net margins. Historically deep in the red, but suddenly a sharp reversal. That first ever GAAP net profit, $61.8 million in Q1 25. Compare that to a $24.8 million loss in Q1 24. It's a monumental swing. That inflection point is what caught the market's eye.
And after years of burning cash, what about free cash flow? Are they finally generating enough cash to keep the lights on themselves?
Yeah, free cash flow, or FCF, the cash left after CapEx. For years, it was hugely negative because of all that investment, like negative $240 million in 2023. But then 2024 saw a dramatic improvement, down to negative $9.4 million. So they are right on the cusp of FCF breakeven. That's a critical milestone. Becoming self-funding is huge.
Okay, but that Q1 profit, it's still just one quarter after a long history of losses. How stable are these financials, really?
That's the million-dollar question, isn't it? That Q1 profit is huge, but it is just one data point. The long history of losses is a definite risk factor. The market needs to see consistency. Look at their debt-to-equity ratio, 61.2%. That's $278 million in debt versus $454 million in equity. It's down from highs, but still considerable for a company just hitting profitability. Adds financial risk. On the plus side, their current ratio of short-term assets versus liabilities is about 1.32. That generally suggests they have enough liquidity for near-term obligations.
And still no dividends, I assume?
Correct. Still focused on growth and proving out sustainable profitability. No dividends, no buybacks.
Okay, let's talk valuation. PE on past results doesn't work because of the losses. But if they hit that consensus EPS of 0.09 cents for this year, what does a forward PE around 31 mean at the current $2.83 price?
It basically means the market is already pricing in quite a bit of future earnings growth. Now, their price-to-sales ratio, PS, is about 2.1. That's calculated using the $883 million market cap over their trailing 12-month revenue of about $415 million. That 2.1 PS is way lower than many of those super high-flying speculative battery tech companies we mentioned earlier, but it's still higher than some traditional industrial companies. So it's kind of in the middle.
For listeners maybe not deep in finance, can you quickly explain what a discounted cash flow or DCF model is trying to do, and what does one suggest for Microvast?
Sure. A DCF model tries to figure out what a company is worth today based on all the cash it's expected to generate in the future. You project out those future cash flows, then you discount them back to the present value using a rate that reflects the risk involved. It's basically asking, what's the total value of all the cash this business will ever generate for its owners, calculated in today's dollars? Now, it's really important to remember, the output of a DCF model is entirely dependent on the assumptions you plug in. For example, there's one publicly available educational DCF model from AlphaSpread. Based on its specific assumptions, it calculates an intrinsic value around $1.76 per share for Microvast. That suggests potential overvaluation compared to the current price. But again, it's just one model, one set of assumptions.
And what are the key assumptions that really drive that DCF value for a company like this?
Two big ones usually. First, the future revenue growth rate. You typically assume high growth for, say, 5-10 years, then taper it down to a more modest long-term rate. Second, the discount rate. For a small cap like Microvast, with its history of losses, debt, and significant geopolitical risk, you'd need to use a relatively high discount rate to properly account for all that risk. Tweak either of those assumptions significantly, and your calculated intrinsic value changes a lot.
Makes sense. Okay, let's shift perspective now to Chapter 4, market sentiment. What's the overall vibe on Wall Street about Microvast?
It's kind of cautiously optimistic, I'd say.
Yeah.
There's definitely excitement about the turnaround, but also hesitation left over from the past struggles. The consensus rating tends to be around hold or maybe moderate buy. The average 12-month price target falls somewhere between $4 and $5. Compared to the current $2.83, that implies pretty decent potential upside, like 41% to 77%. But look at the range of individual analyst targets. It goes from $3 all the way up to $5.25. That widespread tells you there's still a lot of disagreement and uncertainty out there.
And we know Q1 results were great. How did that shift the media narrative?
Oh, it definitely shifted things. The recent news tone has been much more positive than in past years. Coverage is really zeroing in on those Q1 numbers: record revenue, jet profit, margin expansion. It's kind of temporarily pushed the older bearish themes into the background.
But then you look at something like short interest. That tells a very different story, right? A lot of skepticism remains.
A lot. It's a really telling indicator here. Almost 31 million shares are sold short. That's nearly 16% of the float, 15.95% to be exact. That is a very significant number. It means a big chunk of the market is still deeply skeptical about whether this turnaround is real or sustainable. The days to cover is about 5 days. That means if good news hits like strong Q2 earnings, those shorts might have to buy back shares quickly, which could fuel a short squeeze.
And what about the technical chart patterns, moving averages?
Well, the 50-day moving average, which gives you a sense of the short to medium-term trend, is around $2.98. The current price at $2.83 is just below that. So getting and staying above $2.98 would be a bullish signal technically. But the 200-day moving average, the longer-term trend indicator, is up at $3.30. The price being well below that suggests that, despite the good news in Q1, the stock hasn't technically reversed its longer-term downtrend yet.
So it really feels like this fascinating standoff. You've got fundamental data pointing towards a real positive shift, but market sentiment, especially that high short interest and the technicals, is still very skeptical. It's like the market is saying, okay, Q1 was good, now prove it again.
That's exactly it. A prove it stock right now. Q2 earnings are going to be absolutely critical.
Okay, let's pivot to Chapter 5, ownership structure. Who actually holds Microvast stock, and what clues does that give us?
Well, overall institutional ownership is actually pretty low, somewhere around 11.3% to 11.6%. That's less than you might expect. However, the recent trend is interesting. In the last reporting period, 60 institutions increased their positions, while only 28 decreased. That's a positive sign. You see the usual passive index funds like Vanguard and BlackRock, but what's more telling is recent buying by active, sophisticated players. Millennium Management, Goldman Sachs, Marshall Wace. They all significantly upped their stakes or started new positions in Q1. That smart money movement can sometimes be a leading indicator.
And what about insiders? We know the CEO owns a lot.
An exceptional amount. Total insider holdings are high, around 27.7%. And yeah, the vast majority of that is CEO Yang Wu's 26.44%. That creates incredibly strong alignment with shareholders. And looking at recent transactions, there hasn't been significant open market selling by key executives, mostly just non-market stuff like stock awards. That's usually seen as insiders keeping faith in the long-term prospects.
So overall, ownership is quite concentrated then.
Highly concentrated, yes. Between the CEO's massive stake and another large chunk held by private equity firm CDH Investment Management, about 12.5%, big portion is locked up with long-term holders. The general public actually holds the largest piece at 48.5%. Institutions, as we said, are relatively low. Now, you could see that low institutional ownership as a risk, like maybe the broader market hasn't validated the story yet. Or you could see it as a huge opportunity. There's tons of room for more institutions to come in and build positions if the turnaround continues. That could provide significant buying pressure. But that concentration, combined with the high short interest, it definitely adds to the potential for volatility. The stock could move sharply on news.
Makes sense. All right, let's tackle Chapter 6, risk assessment. Let's try to do a quick SWOT analysis. Strengths, weaknesses, opportunities, threats. What are Microvast's core strengths?
Okay, strengths. Number 1, vertical integration, the control over tech, quality, cost. 2, proprietary technology, the 810-plus patents, especially safety tech, give them an IP moat. 3, founder-led management CEO with deep history and huge personal stake aligning interests. And 4, established manufacturing footprint, scaled plants in key regions, including the U.S. ramp-up.
Got it. Now, the flip side, Weaknesses, where are they vulnerable?
Weaknesses are significant too. One, that long history of unprofitability makes the recent profit look fragile. Two, the significant debt load, 61% DE, adds financial risk. Three, geopolitical concentration, heavy dependence on China for operations and revenue is a major risk point. And four, those past internal control issues raise questions about their back office processes.
Okay, despite those weaknesses, what are the big opportunities out there for them?
The opportunities are huge. First, massive market growth, just riding the waves of electrification and EVs and energy storage, with that 25% plus KDR market growth. Second, supportive government policies, things like the IRA in the US and the Green Deal in Europe, are designed to boost exactly what they do. And third, expansion into energy storage. The grid needs massive batteries, and Microvast is moving into that space with new container products. It's a potentially enormous new market for them.
And finally, the threats. What could really derail this story?
Threats are very real. One, intense competition from giants like CATL and nimble startups. Two, raw material volatility, lithium prices bouncing around can wreck margins. Three, technological disruption. What if someone develops a breakthrough battery tech like solid state that leapfrogs them? Always a risk. And four, arguably the biggest right now, geopolitical and trade tensions, especially U.S.-China relations.
Yeah, let's talk about those broader factors. How do things like inflation and interest rates specifically impact Microvast?
Well, inflation is pretty direct. It can push up costs for raw materials, components, labor. If they can't pass those increases on to customers, those nice new margins could get squeezed. Higher interest rates. That increases the cost of servicing their existing debt and makes borrowing for future expansion more expensive. Plus, from a valuation standpoint, higher rates generally mean a higher discount rate used in models, which tends to push down calculated intrinsic values.
And let's really zero in on that geopolitical threat you mentioned. You called it maybe the single biggest risk. Those U.S. tariffs imposed in 2025, how exactly do they hit Microvast?
Yeah, this is critical and direct. The escalating U.S.-China trade fight and new U.S. policies in early 2025 mean cumulative tariff rates on some Chinese imports, including battery parts and materials, are approaching 125% in certain cases. This hits Microvast multiple ways. It directly inflates their cost of goods sold, even for batteries they assemble in Tennessee, if key upstream components still come from China. That puts those hard-won gross margin improvements in serious jeopardy. It forces a really tough choice. Either they absorb the higher costs, which could wipe out profitability, or they try to pass the costs on, which makes them less competitive on price. This geopolitical headwind is, I think, the single biggest external risk they face right now, and probably a major reason why that short interest is so high.
That is immense pressure. Okay, let's try to synthesize all of this. Chapter 7, conclusion. Can you lay out the core bull case versus the core bear case for Microvast?
Okay, the bull case, in a nutshell. One, massive market opportunity in EV and energy storage, riding that 26% growth wave. Two, proven technology and IP moat, 810 plus patents, 31K plus systems deployed, strong safety focus. Three, financial inflection point, Q1 showed record revenue, first GAAP profit, big margin jump suggesting operational leverage. Four, founder-led with high insider ownership, CEO's 26% plus stake means strong alignment. And five, seeing some smart money accumulation from sophisticated institutions.
Right. And the counter-arguments. The bear case.
The bear case is led by that huge geopolitical risk, the China dependence and vulnerability to tariffs threatening profitability. Two, intense competition from huge players and startups. Three, fragile financials despite Q1. The history of losses, cash burn, and significant debt means stability is precarious if profits aren't sustained. Four, that high short interest, almost 16%, signals deep market skepticism. And five, some backlog uncertainty after recent volatility raises questions about future growth predictability.
So, tying it back to valuation, what's the summary there?
It's definitely mixed. On a relative basis, like price to sales, it doesn't look wildly expensive compared to some peers, especially the more speculative ones. But that conservative intrinsic value estimate we talked about, from the educational DCF model landing around $1.76, that suggests potential overvaluation at the current price. It really highlights that to justify today's $2.83 share price, you need strong conviction in their ability to execute on high growth and maintain those high margins long term.
So, Microvast Holdings. Really standing at a critical crossroads. The whole narrative has shifted, hasn't it? From just speculative growth to showing actual operational leverage, actual profit. The current share price clearly reflects this active debate in the market. Analyst targets point upwards, some significantly, but that intrinsic value model flashes a caution light. Ultimately, it seems the investment case really boils down to one core question for you, our listener. Were those stellar Q1 results the start of a genuine, sustainable trend of profitable growth? Or was it just a temporary bright spot, an aberration? And that upcoming Q2 earnings report on August 11th, that's going to be absolutely pivotal. It'll give us the next crucial piece of data to help answer that very question.
Yeah, that report isn't just numbers on a page. It's really the next chapter in this whole compelling story, and it directly impacts how you might view Microvast's future path.
Exactly. And look, if you found this deep dive helpful, imagine getting insights like this for all the S&P 500 stocks. You can join Stock Analytics AI. It's just $4.99 a month to get priority deep dives and exclusive access. We're planning to cover all of them. Or, hey, if you just wanted this one deep dive on Microvast, dropping us a super thanks really helps us out a lot. And remember, we will be covering Microvast's earnings basically moments after they drop, so stay tuned for that quick breakdown.
And the important disclaimer: this analysis was generated by an AI system. It's for educational purposes only. It should absolutely not be considered financial advice. Please always do your own research or talk to a qualified financial advisor before making any investment decisions.
Thanks for joining us on this exploration of Microvast. Keep diving deep into knowledge.